confused, so I do 10, then we do la 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 la, and then when we come back, we do the other 10, you know. So that way you remember yourself, you remember the person you want to remember much better.
Great.
All right. Okay, so we're gonna start off the whole subject thing a little bit easy and straightforward. It's gonna get a lot more difficult as we go on. But let's talk about investment philosophy, and stop me whenever you have questions. Just stop me and ask your questions. All right. Before getting into the philosophies, let's sort of set some boundaries. As Chuck said, we need to have some sort of a common language to be able to speak with each other. Can anyone tell me what is market efficiency?
Yeah, it's when the information are reflected in the price, and it has different, type of efficiencies. Sometimes it's weak or semi-strong or strong. And the information, if it's public, if the price reflects the public information, that is semi-strong. If it's the private and the public, then it's going to be strong, which is, I think, hard to do.
Yeah, and the sort of the premise is that, can you make a profit when the markets are fully efficient consistently? Assuming it is, let's say.
Actually, I think you have to go with the passive strategy, because it's hard to beat the market if it's fully efficient.
Yeah, beautiful. Well put. So the idea is, let's say, you're trying to buy Tesla stocks, right? You think Tesla's a great company, right? But if everyone else thinks the same thing, the Tesla price is going to be where it's at right now. So what is the PE ratio of 320 something? And you're not going to be able to make money off of that. So the whole premise of this is that you're going to have some ideas that is going to be a little bit different from the rest of the market to be able to make money, to be able to beat the market if they say it. And that's the premise of it. Does that make sense to everyone?
I was just talking about like efficient market theory and like the ability to like make arbitrage like gains.
Yeah.
I mean, in perfect market, like people can make arbitrage gains, but in a perfect market, not. It's just everyone's catching up if they all have the same amount of information.
Yeah, true. So the market is in no way like fully efficient, right? But the idea is like it is efficient enough that you have to have a decent idea. Not everyone with a penny can make a buck in there. It is extremely competitive. You have to, whether if you're an arbitrager, your time window, we'll talk about it in a little bit, is shorter. You want to make the profit based on whatever model you have going on and just close the gap there. But if you're a long-term investor, you might have an idea where company A is undervalued for like reasons A, B, C, D, E, right? And we'll get into what you can base those reasons on in a little bit. But that's the sort of the premise of the market. You have to have basically a viewpoint that is a little bit at least different than the price that you're seeing. And that sort of gives you the idea to go into it. Now, with that in mind, any other questions on that? Is that good? All right. Just setting some, vocabulary premises, if you will. All right. So let's say you beat the market, right? You make a lot of profit. And I don't know, let's say you bought a lot of Bitcoin or whatever. Not over the past 6 months, but something else. You shorted Bitcoin, let's say. And you made a lot of money, right? Now, the fact that you made a lot of money, is it because you're a superior trader, or is it just because you're simply taking more risks? I could go, someone buys the lottery and wins in the end, but the odds are against you. Now, is that someone, the best lottery buyer, the best investor, or is it just simply more risk taking? How would you sort of evaluate this thing? Let's say someone buys the S&P 500 and makes money, and someone else buys Bitcoin or Ethereum or something else.
I kind of feel like it could go either way. Like instead of making a gain, you could minimize your losses by being an efficient trader.
Yeah, but whereas
if you take on more risk, you get more reward, obviously.
Exactly. And now we're getting to the whole investment philosophy thing. And that's the main thing that drives the investment philosophy is the risk tolerance of a person, right? Depending on your personality, you might be into it. You know, at some points you're like, I'm more into more risk, more reward. I'm more into making money short term. I'm more into whatever, right? And some people are just not. And depending on your clients, whether you go to the industry, the firms you work with, they might depend on, you know, either way of these things. Good. Now, we established that sort of the risk situation, and I just put an example of the, you know, Treasury and the S&P 500 here, just to, you know, the simplest sort of comparison to be. If you're like extremely risk averse, go buy Treasuries, you know, earn your, I don't know, less than 1% at the moment ish, or like close to 2% if you're long term anyway, and make your money that way. If you're a little bit more of a risk taker, you're going to put your money in S&P 500, let's say. If you're a crazy risk taker, you're going to get into the Bitcoin stuff, maybe commodities, derivatives, whatever you're into. Now, having this sort of whole risk structure there, we might sort of try and separate two things out. Like, there is risk tolerance and there are sometimes just irrational choices, right? And people try to make distinctions between these things in the industry. So let's look at this chart, let's say, and you know, you're an investor or whatever. Which one of these things would you get? Let's say you can buy around here towards the beginning of the chart.
XYZ would give you less anxiety.
Yeah,
Would depend
I would
on
say
the
XYZ seems less volatile than ABC.
All right. Less anxiety. I like that. Jamie, you were about to say something. Go ahead.
No, I made the comment about the anxiety.
Oh, you did that? Okay. I
Yeah.
just saw you mute.
Guys, can you hear me, Professor Burns?
Yes, I can hear you. Go ahead.
Yeah, so I would agree on XYZ also because it seems less volatile compared to ABC.
Yeah, exactly. So
Yeah.
sometimes it's an obvious choice, right? You're just like, I'm basically taking more risk for, you know, nothing. And that past example, someone pointed out that, you know, okay, more risk, more reward. What's the problem in that? But right now, so there's a rationale choice there for you to make. And obviously, as we get to the practice side of it, as we go on the class, the whole issue is going to get a little bit more complicated. But we have ways of sort of measuring this risk. And we have a bunch of different ones that we can look into, right? And I'm sure you've all taken courses and all that. You've heard of these. And the most sort of obvious one is the volatility, the size, the liquidity that you have. And that's why you say the financial firms, when they're reporting their performances, they're reporting, let's say, the Sharpe ratio. They're controlling for the volatility in that performance. And that's how they measure and compare their performances. And that's in no way perfect. Maybe someone cares about inflation risk. Maybe someone cares about something else. And that gets into the philosophy a little bit too. And it's sort of whatever personality you're into. But you need to sort of try and find a way to like sort of determine whatever risk you're comfortable with and make decisions based on that one. So you're trying to understand and make a sort of a risk advised decision. It doesn't matter if it's high risk, high reward, but you just need to be aware of like, this is a high risk, high reward situation. You shouldn't expect the stability when you're going that route. And we'll talk about these stuff, you know, when we get to the fundamental analysis segment of our course. Now, let's get into the investment philosophy, having set the boundaries of this whole discussion that we're having. Now, an investment philosophy is just a set of beliefs, you know, that an investor follows. And it generally has to do with, you know, the risk tolerance a person has, the situation they're in, and the time period they're looking to invest. And all of you might have different opinions of what an investor, probably those of you who are a little bit older are not dabbling in, you know, meme stocks in Robinhood. Maybe younger people are more interested in that. Maybe you have a low fund set aside for more risky stuff. So it depends on your personality, and that's the whole sort of scheme of this thing. And the most popular ones are the value investing, growth investing, passive, long-term, short-term. And we'll talk about that in a little bit to sort of see how the general mindset works a little bit. Now, before we get into that, let's see who's what in this class at least. So you have these two scenarios, and scenario red, buy a well-established stock now, worth $1 at the moment, that in 5 years, 50% it will be worth $2, 50% it will be worth $4, right? You have a simple expected value of 3, basic enough, and you'll triple your money in 5 years. Beautiful. It's close to S&P 500-ish, slightly better, I'd say. Now you have the sort of the whole VC situation going on. You have $1 now, in 5 years, 5% chance you might get $200, 95% chance you might get 0. Now, by the show of hands, who will take the red one here? Right. Okay. Say mostly the majority, but who will take the blue one? And there's no right answer here. I'm not trying to quiz you or anything. All right, we have a few risk-tolerant individuals in our class, as we can see. All right, who took the blue one? There's a lot of us here. I'm exploring the screen. One of the people who took. Okay, go ahead. Sorry.
I was just going to say from a purely mathematical standpoint, like the blue has like the higher mean value because with a higher variance too. I mean that is true, but I mean if you look at like these are two, if you imagine these as projects,
yeah,
and you have to like look at the expected value of the two of them. There's a 50% chance that red will be worth $4, so that's $2, and a 50% chance that it'll be worth $2, which is $1. So yeah. I guess that like you could expect that to have a value of $3.
Yeah.
Whereas 5% chance.
Can I just sorry.
Sorry.
Just wanted to do the opposite of that one. Just something you might want to consider, John, is not only the upside, but every trader or investor, sometimes they want to look at the downside first, because it's easy to say that when you're looking at $1, but think about it. What if you're putting $10 million in this project, right? You're looking at a 95% chances of losing $10 million. That's the downside, right? So who cares what the upside is? $10 million are at play for a 95% chance of vanishing into thin air. So that would be like the rationale behind it too, kind of just to play devil's advocate.
I like this. All right, you go ahead, John. What's your response to that?
I mean, my response to that would just be like, if you hold on to $10 million, you have an 100% chance of retaining it. But the longer you hold on to it, the more it just loses value innately. I mean, if you think about inflation as a factor.
Well, let's just this basic problem. You put it in a red one, you triple your money, right? Expected value, or you double it with 50% chance or whatever, right? Mm-hmm. And that's the thing. Like, I don't think there's like any wrong, because when I set this up, the expected values, obviously the blue one's high, right? If you're a rational decision maker, but the variance and the downside risk, every sort of risk you can think of in the book is higher for blue, right? And
go ahead. I was just trying to, one thing which Faraz is saying and what Ali said, John, there is a very good evidence in our business that $1 less has higher disutility than the utility from $1 gain. So basically, if you lose $1, it hurts you more than if you make $1 gives you the pleasure. And that in Faraz's terminology is, indifference curves are convex, right? So that's the principle of risk aversion. The principle of risk aversion is that the downside, like Ellie says, that in his business, people will come to say, how much will I lose? Because if you lose $10,000, it's going to bug him way more than if he makes $10,000 more. That is at the heart of what Faraz is trying to push. So there's very good evidence.
Also, I can add a point here. If you just lose, like, let's say 50% worth of your investment, then you will have to gain 100%.
Oh,
so you can go back to the principle that have like picked in the first place. So it's not that easy. I mean, to go back from 50% loss. What about 100% or 95%?
Yeah, that's another way of putting it.
Yeah. Can I add something in support of the blue? We've got a lot of flash on, and rightfully so. I'm very conservative when it comes to that. I would definitely go with the red. But I'm sure I'm sorry, I'm screaming. Yeah, Jamie worked in the tech business, and I'm sure he's aware, like, this is how the blue pill is how the VCs operate. Their chances of success is probably like 1 in 10 to get a unicorn, and the rest of them just go to oblivion, basically. Nothing out of it.
But is the key that you're making 50 of these investments?
Yes.
And even assuming that you're making 50, you can do that, right? Let's say these are multipliable and you can create a portfolio based on these. There's still that risk element to it, right? And some people are just more comfortable with the blue one. Some people are more comfortable with the red one. And there is a point, it's just it depends on what your utility function is at a point in time. And that's the sort of point. Someone else was in the blue camp as well. It was Dolly, I think. What is your rationale for this?
I just picked the blue one because I thought it would be more fun to watch than the red. That's it.
I respect that, yeah. That's a good reason as any. I like that.
I can speak on blue as well, if you're looking for people. So it goes back to each of our individual investment philosophies, which I think is the point that Faraz is trying to make.
Yep.
The point I'm at in my life now, I would rather, I'd rather be the blue pill because I don't have a family to support. I, am financially secure, and the money that I'm putting into the stock market is money that I can completely lose, but I'm willing to risk completely losing it for the chance of, hitting the lottery stock and whatnot. And, ideally I'm doing what Jamie was saying, and I'm making a significant amount of these blue pill stock purchases. And so it'd be, in my mind, I'd be 75% blue with 25% red. So I have a little bit of background because it's not in a vacuum where you can only buy one stock, where you could, back up your blues with some reds as well. But I think the point that Faraz is trying to make, that it all just goes back to our investment philosophy and, how we view the money that we're investing.
And you're exactly right. You exactly given Faraz the bridge, because now he's going to bring you to value and growth investors. So Jamie and you perhaps will be in the growth investing. You'll be looking at different macro parameters than a value investor, right? That's where we are going.
Yeah. Anyone else, any comments on their chosen pills? We're glad to hear it. If anyone else has anything to add.
I agree with Nick too. I was gonna say, if I had a choice, I probably wouldn't go with just red or blue. I would go with both. I think as time goes on, first of all, I think I also agree with Nick that I would use some money to invest when worst case scenario, if I lose it, I lose it. Now, of course, nobody wants to lose money, but I think it's never good to use money that you need to pay bills with to invest, because it's gonna put yourself in a really bad position. I think I would go with some red and blue just so that I'm not putting all my eggs in one basket. No, so there is some conservative to it, but then at the same time, I think it also depends on where you're at your life too, whether you need it soon, in the next year that you want your return back, or you want, you're willing to wait it out too, because for the most part, I think, if you're willing to wait it out longer, normally speaking, I mean, things do happen. You should have a pretty good return on either way.
Yep. Yeah, nicely put. See, you touched on a couple of other things that we're eventually going to get to, because, predicting individual stock is one thing. Forming a portfolio on those predictions is an entire different animal. And the second thing is the time sort of horizon, which again goes into the investment philosophy. Now, hold your red and blue pills, like, whichever way you're leaning, or a mixture of them, right? Would you buy the blue pill with your retirement account? The people who said they're into the blue pill?
Absolutely not.
There we go.
Yeah, absolutely not.
I would, with a very small percentage though.
There we go. What about you, Nick?
No, I want to say yes, but realistically, I would not.
There we go. So there are limits to these things, right? And it depends, like once you go to the industry, like these different firms have different horizons. Mutual funds hold a sort of position for and they handle these sort of safe-ish assets, right? If you go work in a hedge fund, they might be more a little bit towards the, all right, let's take some blue pills here and there. If you go to a VC business, similar, right? And depends on sort of which type of philosophy and approach your industry is going to take. And I bet all of you has a point in time where they would change their minds with regards to the choice they're going to make. Depends, if I make the blue pill thing, expected value 100 times bigger, you might be like, okay, it makes sense for me now. If I make the payoffs a little bit different, you might switch again. And that's the sort of idea of this investment philosophy, where you're like, there's not 100% right choice, if you will, but it sort of, if you want to look at it via the lens of the theory you've been taught, is you're basically tuning your utility function. Like, depends on what gives you reward, and go into that, or if you have clients, that's what you're working off. And so with that, let me just sum up the whole 4 categories that I at least please everyone add to this if you can, because investment philosophy is vague to begin with. I'd say risk tolerance, time horizon, your domain knowledge, and personal utilities are the main things that will make your investment philosophy. Some people know certain sectors. I don't know, even like the mega successful investors, even Warren Buffett's like, I'm not investing in businesses I don't know about. So some of it is just, your understanding a certain field, you have your time horizon, and you have your personal utilities. Nowadays, we have people who just don't invest in tobacco stocks, let's say, or alcohol stocks, or gas companies. They're just, it doesn't make me happy to do it. Now, we don't know if that's wrong or right, but like the idea is that that has a little bit to do with it as well. I don't know how much, like halfway-ish through this, we can do a break right now and come back and do the other half after the break, or we can keep going, depending on what you guys feeling like.
I've got no preference.
I'm good to keep going if everyone else is.
All right, let's do hands up if anyone wants to break now. All right, no one wants to break. Jesus.
This is good news, because when they taught us how to teach in Zoom, they said every hour you go to ask Chuck, every hour. Otherwise, nobody's going to listen to you. I said, okay, no problem.
All right, let me at least grab a sip of water then, since we don't want to.
It's getting interesting with the red pill and blue pill concept.
All right. Now, again, to sort of push the point, and I swear to God, this happened by accident. This chart came in red and blue with the same dynamic. This is NASDAQ versus S&P 500 over the past decade-ish. And it's the same concept. And you could be more confident that my made-up problem, right? And because this is actually like priced properly, I just made up some numbers in my head. But you can see, like, you can argue that NASDAQ's better than S&P 500, but it's also riskier. If you look at the 2008 crash, you can see the NASDAQ, lost more money compared to S&P 500. And whenever, they made money, NASDAQ made more money. So it's more risk, more reward. And depend on your type, if you're like a growth investor and whatnot, you might be more into that. If you're, younger, depending on your clients. But you have to know what you're into. Like, you can't be like, I'm investing in NASDAQ and I'm expecting risk levels of like T-bills, right? You have to be honest with yourself when you're doing that. Even like the people invest in crypto, if you know like what you're doing and the levels of risk, fine, good, do it. But like, this is extremely risky, right? And people have different preferences. And with that aside, let's go to the sort of one of the main investment philosophies that have been stuck around for, a good while. Value investing, right?
Think of Warren Buffett as he goes through. Just imagine, those of you kind of familiar with it, he's talking Warren Buffett.
Yeah.
When he talks about growth, think about ARK investment, in this context.
I have their performance charts next to each other to compare the two theses later on. So again, like, if you recall the first slide, what is value investing? The premise is quite simple, right? The idea is like, the market's wrong, I know better, right? Whatever thing, that Tesla stock you're looking at, the Google, you're just like, okay, I have a better way to price this compared to the aggregate entirety of the market. And you have a view, right? You're like, okay, I get to this value, fair value, they call it whatever, like, we have no way of truly determining that, but we have way of like getting close to it. Fair value, and you're like, okay, this is underpriced, overpriced, whatever, right? But the premise is like, I can find a value that is better than the market and more accurate, right? That's your thought whenever you're doing value investing. That's the main thing you got to get. And it's very difficult to get that, right? But if you can do that, then the problem becomes simple. You're like, okay, this was supposed to be worth, I don't know, $1,200, maybe with a window from $1,200 to whatever, $1,500, but it's like 900 right now. So like, this is undervalued, I'll go buy it. Or if it's the other way around, you just go and short sell it, right? Now, the issue with this, sort of the main issue, is that like, if no one else in the market can value this properly, like, how can you do it really, right? What makes you so special? And that comes in the sort of the note from the first slide. Like, whatever you're doing, like, it has to be at least slightly different, right? Because otherwise it's already in the price, there's no way for you to have an edge in that position. But if you reach a different thesis than the current price, then you have, ways to exercise that thesis and, potentially make money off of it. Now, what I'm gonna talk about here, you all said you hated theory stuff, but like, bear with me for like a few slides. I like, and most of you know these, I just put it in here for the sake of it, because I think it will complement what Chuck was saying in the earlier this meeting, right? How do you value a firm? I'm sure you've all been thought this, you've been through this, but let's first talk about what is the time value of money, right? And it's sort of straight enough, right? Let's say you have you have a 2-period investment option. I'm not trying to get you to calculate this, but you have a 2-period thing, you pay, $10,000 in 1 year offer for sale, and 9,500 another, and you have an interest rate, and then this interest rate is the like what you use to sort of basically move cash flows across time, right? And depending on what you're doing, and you know that I'm sure everyone's familiar, but just in case we have people from all over backgrounds, can anyone tell me why we have this sort of concept of time value of money, let's say via the discounted via the interest rates?
Like net present value, inflation, like if you're getting like, you know, what it's worth for your investment. I mean, the money loses value over time. Like you want to make sure that if you're funding a project or something for net present value, you want to make sure your investment's going to fund the project and you're getting like
but
a
let's
return
say,
equal.
yeah, but let's say inflation is 0, but you still have T-bills paying you 2%. Right?
There's an opportunity cost of every investment.
Yeah, a little bit of that too.
It's
Now,
every other investment in the market. And so any dollar that you have today, you could use it in an infinite number, well, not an infinite number, but like a multitude of possible.
You can buy T-bills at least. Like if you're the most vanilla investor out there, right? You're gonna go buy T-bills. And the inflation thing is also accurate. And that's why, like, whenever you're evaluating different firms, you use different discount rates depending on what they are. And they usually look at their cost of capital, right? Maybe, I don't know, let's say one of us has a good credit score, we can go get a loan at like 3%, the other one doesn't, and they can go get a loan at 5%. So the cost of capital is, this time value of money could be different for each of us, right? But anyway, if you have a 2-period sort of, let's say, investment situation, you invest 9,500 and you receive like 10,000 after 1 period, and you have a, you know, discount rate that's known to you, you know, the problem's obvious. You calculate the net present value, win, it's positive, let's invest in this thing, right? And this whole thing gets a little bit complicated, right? When you're trying to look into stocks, right? And this is what they refer to as dividend discount models, growing perpetuity. There are different variations of this. And the reason we're talking about this is not that this model is accurate. No, not at all, right? Not even slightly. That I think he was mentioning, like, that the hedge funds referred to this was a garbage in, garbage out last semester, he was saying. Like, because there are a lot of assumptions that go into this, and we'll talk about it a little bit, but it is a really good benchmark, right? And the main notion here is that the value of a stock is basically the, you know, basically you're going to bring all the future cash flows, whatever, let's say Google's going to operate for 100 years, infinite years, whatever it is, right? And you're going to discount that to a net present value, right? And that's going to be the price of the firm. Now, does it make sense to everyone? Please do stop me if it doesn't. All right. So let's say, you know, they have a cash flow period 1, period 2, period 3, right? If it's just 1 period, it's simple enough, right? You just, you know, bring it back, divide it by 1 plus R, and you're set, right? And if you have a, you know, let's say an infinite timeline ahead of you, again, if you break this mathematically, it's going to end up here if you assume a constant growth rate for your, you know, future cash flows, right? And again, this is not a single way to do it. Some people assume multiple different growth rates for different stages, right? You can do a lot of stuff. It's the whole concept is simple enough. You have cash flows in the future, you're just going to calculate the net present value of that thing, right? And you're going to assume these cash flows are going to grow, decrease, whatever, you know, happens to them. The simplest way, I think, is called Gordon growth model, is just assumes the cash flows will increase linearly. I'm sure, like, if you had, you know, in your undergrad classes, someone told you about these things if you're in finance, right? Now, again, this is not accurate, but this explains what Chuck was mentioning earlier in this session. Why do we care that Fed increases the interest rates? What happens to stocks when you do that? Just based on this equation, simple enough.
Their value decreases.
Exactly. Why?
The denominator of this equation gets larger, and it does so in an exponential way. And so when the denominator gets larger, the overall value gets smaller.
Exactly. Thank you. Right. And again, like the theory stuff, you know, some of you may hate it, but like they have their applications once in a while here. And this sort of simple equation is basically telling you why the stock market's going to crash, because, you know, the future discount, because, you know, you could just go buy T-bills. Why would you buy stocks or whatever? You can go buy bonds. And again, with the same logic, could someone else, and Chuck mentioned this, we talked about it a little bit, just based on this simple thing, could someone tell me why this will hurt firms that are growth firms more? The firms that are, you know, I'm not talking about necessarily like the Googles of the world. I'm talking about, let's say, Snapchat, or, you know, these types of companies that are a little bit newbies. They don't have a, you know, solid current cash flow, right? They're promising cash flows here rather than here.
They're running on borrowed money.
Partially true, yes.
But money far away.
Yep. And so again, if you want to look at this, right, and let's just like, if you look at this, if there's Snapchat is like, or whatever company is telling me they're going to give me give me $100 million in cash flows, right, in 50 years, right? But they have zero money from now to 50 years from there, right? And if you try to discount that money from 50 years from now to current time, and your interest rate is just like, you know, increased by 2%, that's, you know, to the power of 50 on your denominator, right? That money is going to be worthless today. But, you know, the Costco's of the, maybe not, I don't know, Walmart, McDonald's, even a little bit Google's of the world, they have the cash flows here as well. So that it's just like they're promising you money in the future that's going to be worthless, right? And that's no more theory bits, but that I thought like it would add to the discussion and, you know, make sense of the whole current interest rate situation. And we have ways to find this out, like you don't have to like write the, you know, get your calculator out. Bloomberg has functions and you can calculate these things. And having said that, let's talk about the issues with this model. I already mentioned it a little bit, right? What is the problem? Like, why doesn't everyone just use this thing and, you know, make a buck for a living?
Assumptions. So everyone has different assumption, and sometimes you might assume something wrong, and the value going to be different. And that's why investors
what kind
have
of assumptions
like,
matter?
Growth rate, interest rate. I mean the required rate of return. Mm-hmm.
Yep, exactly. So, you know, there's a lot of, you know, confidently, possibly, most likely wrong assumption that goes into this thing, right? If you can tell me, you know, what interest rates are in 10 years from now, you're just, you know, you're the oracle. Like, you don't even need to buy stocks, right? Using the dividend. Or if you could tell me what the growth rate's going to be for Google in, I don't know, 10 years, just like tell me, like there's no need for this, right? But the good thing is, like, it will give you a benchmark for different scenarios. And I think that's like one of the ways that industry uses. Like, you get like, I don't know, 50, 100 different scenarios out of this thing. It will give you something to like, okay, this is a reality-ish that we might get to. And you can make this a lot more complicated, right? You can make this like, I don't know, the variety of different growth rates or whatnot, variety of different interest rate scenarios, and just, you know, get estimations on that. Well, anyway, that's the sort of direct way of doing it. Another way of sort of driving values, you're basically, if you're a value investor, you're trying to say, okay, one, I know what value is better than, you know, what the current price is telling me. Another way is let's just forget about like making assumptions to the infinity and just like look at, you know, how a single company is, you know, with respect to its peers, right? You go into a sector, you look at a company like, I don't know, 10 companies, they're doing the same thing. And you have a bunch of stuff you can look at. And ideally, you want to be able to conclude that one of these companies is either undervalued with respect to its peers or overvalued with respect to its peers, right? I know, like, if 6 months ago, 7 months, and we'll get into this ratio stuff a little bit more on the terminal next week on the fundamental section, but like an example, I think it was 8 months ago or something like that. If you looked at Target, Costco, and Walmart, this was a sort of a decent-ish approaches because the PE ratios were semi-similar, and you could sort of find ways to tell, okay, this business is undervalued with respect to its peer, given its competitive advantage or whatnot. But I'm not going to talk about this too much, but the idea is you just like comparing relative within each firms. And we'll talk about this a lot more in our fundamental analysis segment. I'm just going to touch on it as, you know, probably a better way to look at things compared to dividend discount model. All right.
Yeah, that's about 7 o'clock. Yeah, we should take a break now.
All right.